Welcome to the Nuts and Bolts of Real Estate podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
I'm high energy today, Joe, which is not a surprise. Big part of that is A, just had my fancy drink I mentioned to you guys, but B, I got one of my favorite people on the planet, aside from you, Joe, Mr. Augustus Bukowski, the master, the man himself is in the house with us today. If you guys have not heard of, met, read the wonderful posts and threads and advice that we call him Augie, we're going to go with Augie, has, showered on us over all these years through our local real estate investment scene, through Washington Real Estate Investing or Seattle Investors Club or any of the other places where you follow your real estate action. Augie is the branch manager over at Cardinal Financial, one of the most talented and my go-to lender for sure, hands down. As you will learn today, the reason why that is, he is also the founder of Seattle Luxury Homes, a very, very talented developer and property reposition expert, investor himself. Every strategy you can think of, this is your guy. He's kind of like the J-Lo of real estate. He's the triple threat, as we call it. So, and look how gorgeous he is too. No Hawaiian shirt though for us today. What's up with that?
Well, it's not February yet. So I can still stand Seattle while it's like 60s. Once we get down into the 40s, I gotta jet out to Maui. So
I hear that.
Yes. I still am wearing a Henley t-shirt because I got to get the last of the sunshine, vitamin D, before it turns completely pitch black.
Nice. Yes, I'm with you here. Well, it's a good day out here today in the Pacific Northwest. I'm looking out here at the Olympic Mountains. There's about 50 boats out there. So I guess it's fishing season. But let us today, guys, we are going to rock your world with not only a market update and some good investing strategies that you should be thinking about today. We're going to be talking about how you should be backing in and thinking about how to even get started or reverse engineering into your real estate deals. But what do we say? We have many podcasts that we've done in the past with Augie guys. Joe can drop those down in the notes there for you guys to get to know him even better. But for those of you who have not yet been blessed with getting to speak to you and do a deal with you, give us a little mini version of what you're all about, and then we'll kick it off.
Absolutely. So I grew up in Seattle in the Finney Ridge area, and I got interested in real estate as soon as I graduated from college. I didn't come from a family that had a lot of money, and so I had to do this just like most of the people out there that are interested in investing. I only had about $2,000 in my bank account in 2012. Now I have over 8 figures of real estate throughout the city of Seattle 10 years later. And basically what I like to do is I really like to help and empower people who are getting started to build portfolios of real estate. The reason why that's really impactful for me is because, my family, I actually had to buy my dad's house off of him so he could retire. And then he took half that money to buy a cheaper house up here in Edmonds by us. And then the other half of his money, I actually lend out as hard money so he has income. So that was fortunate for him, but it happened because I was in real estate, so I was able to do that for him. And then I was able to translate that additional real estate success to setting up my family so that would not need to happen. So if I can do it, you can do it too. Not everybody has to do absolutely everything I do, right? Like not everybody's going to be a home builder. Not everybody's going to build multifamily apartment buildings, but you don't need to. If you simply buy a few homes correctly that do cash flow, you'll be leaps and bounds ahead of all your peers, even those that make double or triple your income. So that's where I like to focus. And those are the people that I get the most joy out of helping.
And I want to add something in there for all you parents. I'm a parent of twin girls starting 8th grade, and we're a real estate family. And I think it's important for the kids. You can set your kids up from day one. Right? You guys tell my kids, you are not going to own necessarily a house as you get started. You're going to buy some multifamily. You're going to live in the units. And, whatever we're talking about here on all these podcasts, and especially this one today, think about your kids. Think about when they're getting started and their first jobs, they can let them do better than you. That's my goal for my family. And we're doing pretty good, but I want my kids to have their choices, by the time they're in their early 30s, on being able to just simply follow their passions, and real estate investing is the way to go. So I know you've got little kids too, Augie. You guys done over there or what?
Oh my gosh. So we have two under five. Boy is four, girl is two. Girl babies are fantastic. Sorry, boy babies, but girl babies are fantastic.
Girl
We
dad.
are we are probably going to have a third. We are going to call it good after that. No four babies. And I just turned 38 last Friday, so
Oh, happy
kind of getting a
birthday.
little bit older, and I'm like, okay, we're going to settle down after before 40. I can't have another kid after 40. Just personally, I'd like to actually enjoy some time. And any of you guys out there with kids under five, it's a handful. You don't get very many moments in a day or in your free time. So I'm looking forward to that kind of over the next decade, I guess. But maybe you could tell me more about that, Julie. I have
Oh
no
yeah. I mean, middle school sucks is all I can say, but
idea.
once they start into eighth grade, it's roses again, but it's all good. It's all good, brother.
We're really
And
selling everybody on having a bunch of kids, right?
what's that?
We're really selling your view of
Yeah.
having kids.
No, you guys all know it's beautiful. It's beautiful.
Yes.
It's all worth it. Keeps you humble.
Yeah,
It's a
and,
lot of
and
fun.
honestly, that's been a lot of my motivation to continue to go, right? So I think part of my original plan when I was very young, right? So when I just got into this business was, oh, I had the same goals as most people, right? Like I want to have $1 million by 30. I think that's a very common goal I hear with real estate investors, right? And then those goals were met, and then it's like I want to have XYZ income, that was the next goal, or I want to hit $5 million of net worth or whatever it might be, and then continuing to grow from there. And part of it is if I didn't have kids and I didn't have that need to actually push through and hit those goals, I'd be pretty content. I mean, honestly, with $1 million, I might move to Montana, get a little shack
Yeah.
with an Xbox or something, and be a bum. But with the family, it pushes me to say, okay, I want them to have a different life. I want to have this to actually do, and it's going to be fun to
We
spend time with them.
absolutely, we should cover this on a different show because, everybody, lots of people talk about house hack and moving. And as a parent myself, and taking risks in real estate, calculated risks. It's a really good topic because not everybody's in the same place in life and with their family. And, my own self, I'm probably way too conservative because we do have it good and we've got a good life. And I don't want to disrupt the lives of my children if I made a mistake or I got caught in a bad downturn. And nobody ever talks about that not everybody can move every year. We've got kids in school. They want to stay, family first for me, wealth and growth and that, stability counts. And so let's table that one and let's circle back up another time on if you don't have the flexibility to do some of the strategies that require, moving around or taking a lot of risks. What are the best things for those that want to remain stable while they're starting their investment portfolio? If you know what I'm saying. It can be
Definitely.
scary. You don't want to rock the boat. You don't, necessarily, I don't want to disrupt, and it's a risk aversion mentality. It's all personal, but when you can't only think about yourself when you have a family.
That's true. We definitely all have the limitations of what we're able to do, and working within those constraints, you can still make the right decisions that put you ahead of where you're hoping to be.
Absolutely. So let's kick it off. What we're going to do here is we're going to hopefully teach you today how to make sure that you are reverse engineering and that you have given yourself a runway with exits while you're investing, right? What do you think what do you want to kick off first, Augie? Should we talk about the current market since today's September 27th? Mortgage market, as you and I know, Augie, imploded a little bit yesterday.
Yep.
And that's some crazy stuff going on for all you investors and anybody on a bridge or a burr loan or, needs to refinance. Woo, what's going on? Fill us in.
Yeah. So, we're coming off of, I got into the mortgage industry in the very tail end of 2007. So, mortgage rates back then were 6.25% to 6.5%. And I was actually refinancing people out of ARMs into 6.25% 30-year fixed rates. And people were very excited for that. What happened right around that time is the housing market collapsed. And what we saw is there was a major problem globally. And the Federal Reserve stepped in and they solved that problem through quantitative easing, which was buying mortgage-backed securities, dropping federal funds rate, to zero over the next few years, et cetera. And what happened is mortgage rates pulled down because relative to other safe bond products, they were still providing a yield. Okay. So after the housing crisis, they kept those policies for a long time until about 2018. Someone can correct me, I might be wrong, but about 2018, they started raising the federal funds rate again and saying, okay, we're gonna slow down quantitative easing, which means they're gonna slow down the purchase of mortgage-backed securities. They started to do so. We did see rates starting to tick up 2018, 2019. And then, of course, COVID happened. And what their concern was that this was going to completely tank the economy. And so using the playbook that they had already done, they went ahead and slashed everything to zero again and basically said, we'll buy all the mortgages. Like basically 15 years ago, almost at this point, we've had a decade and a half of 3% interest rates, plus or minus 8 or a half. So consumers have gotten very used to cheap financing, and they've almost completely, most of the people in the housing market today under 30 don't even know that rates were in 6% range,
Right.
or that the reason they were low was due to federal intervention in the mortgage markets. So what we've seen is we're actually returning to a more normalized market. And that's had some big impacts on mortgage bonds saleability, as well as what the mortgage rate is that a consumer is going to pay. So it's not that the Fed is raising the interest rates of mortgages. They're raising the rate of the federal funds rate, which is a rate banks use to borrow money from each other. But what it is doing is that has an impact on federal or low risk bonds as well. I believe the 2-year Treasury just hit 4.25%, which is a risk-free return, meaning if you invest your money in that Treasury bill that pays 4.25%, you can expect to get your interest and you can expect to lose none of your money. So relative to a mortgage, if I can get absolutely zero risk at 4.25%, I certainly don't want to lend Joe Bauer $500,000 with 5% down on a condo in Texas, right? Because that would be more risky depending on what he does for a job or whether or not that condo association is going to go under. So there has to be a spread between that risk-free return as well as the rate that you're paying on your mortgage. So that's why mortgages are higher. And until we see those bonds, risk-free bonds go down, we're likely going to be in this kind of current mortgage rate environment, at least for, I think it's going to be at least 12 to 24 months before we really see any change. And that's because the federal government is fighting against inflation. And whether or not people agree with what they're doing or how heavy-handed they're doing, inflation of 8% is not good for anybody. So it's not good for me. It devalues my assets. It's not good for you. It's not good for your parents who are retired. I consistently think of baby boomers with their $100,000 saved. Well, that $100,000 is now worth like $50K if inflation continues at that rate. So we are in a little bit of a higher situation. And that brings us to the current market. If rates...
Can I ask you though, what do you think about how wages are going to play into that? The whole affordability thing. We had Jay Scott on, what was that, last week? And that's a good one to listen to. That's coming out pretty soon. But we were talking about our wages going to increase, the whole affordability issue, right? I don't know what you think about wages, if they're going to go up, down, or what, and how that plays in.
So I do have several businesses they're all real estate based. And so that's the caveat. But in each one of those industries, there's a difference in which wages are going up and which are going down. So I know that there are 11 million jobs that are currently open, which is a lot. I know that unemployment is still very low. And so, what I do see is people will likely be requesting more money because the cost of housing is more expensive. Rents are up, housing is more expensive, goods are more expensive. I do not believe, just because of how corporate America works, that wages will grow as much as maybe the expenses are, at least in the current term. And so that will put more challenge on buying. An example of this would be, I looked at it this morning, is a 400-gram mortgage that costs something like, unfortunately it was in British pounds, so this doesn't really translate well, but basically the cost went up about double for a $400,000 mortgage with a 7% rate. So realistically, that consumer isn't going to go from $60,000 of earnings to $120,000 of earnings, which is what would really have to happen in order to actually be able to get that same property. The interesting thing is that, people in real estate equate price to what actually is fluctuating or what people are paying for. But what consumers actually buy homes for and investors actually buy homes for is a monthly mortgage payment.
Right.
So,
like the car business, car sales.
Exactly. And so car sales is all I do basically. It's the 4 boxes. What's the max you can afford, and what's the max monthly payment? What's the maximum down payment? Those are the real things that actually dictate what you buy, and the rest is irrelevant. So
that's why creative real estate is so wonderful. If you can just get the payment amount to what you need, people will pay you a higher price for your property. They just care about the monthly payment.
That's exactly correct. So an example of that would be if a property was only worth $700,000 based on conventional financing, I might be willing to pay $1 million if I got a 2% interest only 10-year note. And then my assumption as an investor is, what is the spread between that price and that payment over that period of time? And is there a delta that gives me a return, right?
Right. One of the other little elephants in the room that I never hear anybody talk about, but I'm pursuing with all my brokers on my VIP education community, one of the things that we're coaching on, which is doable. It takes a minute to research it because most agents have no idea, no clue. You could see a ton of listings out there, or canceled listings, expireds, or off-market properties, or whatever. I don't think anybody's bothering to look. And there are assumable loans that are available. I've got one right now in Linwood. It's got like a 3.25% interest rate on it, and she refinanced at her 80% loan to value last year. So somebody just needs 20% down, or maybe she can do a wrap or a HELOC on a second if the lender will allow. But that is a valid thing right now. Loan assumptions. Still get those loan rates, right?
And we're going to see a lot more creative stuff because, quite frankly, right now in the current environment, and it's bad to say as a mortgage lender because it's going to hurt me, but the truth is rent is cheaper than owning a home right now. And in a lot of cases, it's significant. A great example would be, I live in the Woodway neighborhood, and in Woodway, there was a house that was listed for $1.85 million. It couldn't sell after 90 days on market, and they just leased it for rent on the rental portals for $5,600 a month. That's equivalent of a 3.8% interest only loan with zero down payment. I couldn't get that loan. That loan product doesn't exist, let alone that rate of pay. So why would it make sense for me to purchase that property where my payment would have been approximately $9,000 per month with a 20% down payment and still be subjected to the risk of the market volatility? And
you know where my mind goes? Immediately, I'm like, well, rather than rent it to a tenant who you're worrying about toilets, tenants, maintenance, turning it later, why not? If you wanted and intended to sell it anyways, why don't you offer it up on a lease option?
Yes. And I've actually had a couple conversations with really smart people that have been on your program. And, they were going back out there and saying, I might just go buy a bunch of these properties and just do lease options and then collect the spread. Because right now, this is a unique opportunity. Like, everyone's running around scared out there, retail buyers and agents and everybody, because it is scary. It's bad for people who are invested. But 2007 was bad for people that were invested, and it created the greatest buying opportunity that I probably will ever have in my life.
I am inundated with business right now because of knowing, especially as a broker, you can do all these things as an investor, a wholesaler, as a broker. You can do all these things if you're aware of them. And it is one of the best strategies possibly out there right now that you could know about. In fact, we just did a kick-ass podcast with Mr. Joe McCall. I don't know if you guys know Joe McCall, but he is going to be at the Coeur d'Alene Real Estate Investors Summit coming up here October, I think it's 21st and 22nd. Joe, you can drop the Joe McCall maybe podcast down in the notes there for you guys to get a little overview of what lease options is all about, or call Augie or call me. You must absolutely know about these as an investor, as a broker, as a buyer for yourself. Anybody could get a house right now on a lease option. Literally. you could get your house of your dreams right now. You could pick up so much business if you know how to talk lease options right now, regardless of any real estate investor discipline that you're in, or, I mean, my God. So that's what we kind of want to talk about too today, is expose you guys to reminding you about some of the creative terms. There's almost like a straight line that you should be going down on these deals, regardless of, again, what your discipline is in real estate, investor, wholesaler, BRRRR, but let's keep talking about, changing times and what that means we kind of wrap it at the end, maybe with your beginner tips on how people can look for these deals. But, what do you think on BRRRRs? Because lots of people are into doing BRRRRs. What's the problem with BRRRRs? What do we do right now with people that are in their flip stage or their renovation stage of their BRRRR and just got a little spanking?
Yeah, well, I think that the first thing that people have to remember is a lot of the investors and a lot of real estate agents, a lot of the lenders who are currently in the business have really just gotten here over the last 3 years. And so they don't understand any market other than the hottest market ever. And so we're consistently having to remind these newer agents and folks, hey, this is a different market. This is no longer what does the seller want. Like, I remember literally having a conversation with a buyer's agent that was like, no, you will absolutely offer this price and you will absolutely hold firm. And I guarantee you they'll take it. And it was significantly under asking because the market has changed, right? So because it's changed, and we're looking at this BRRRR strategy, there's two things. One, for people who are actually engaged in finding a BRRRR, it's going to be identifying a property at a lower value that you might not have been able to, utilizing some sort of structure like a lease option or unique, seller carried financing, or just taking advantage of the fact that a lot of the properties are going to be selling for under what their intrinsic value is. I think that what people are going to have to realize on the BRRRR strategy right now, if they're looking to use conventional financing, is that the spread on cash flow is going to be very low right now. I still would recommend not purchasing if there's no cash flow. That is the number one rule I have stuck by my entire investing career, is if it does not cash flow, you do not buy it. But some
people, Augie, might say, well, what's good enough cash flow? I know that's an impersonal answer for everybody, but is that $300, $500 a month for a single family?
I think what you want to look at is depending on what your income is, right? Some people can afford infinite. So if you want to look at what you can afford to lose every single month and still meet all of your obligations and save money. So that might be an example of someone could pay $500 if the cash flow didn't quite hit there. In 1 month, there's a vacancy, or 2 months, there's a vacancy, that they could still be comfortable meeting their own expenses. What we don't want to see is anybody over leveraging, that basically it only works for them if they receive rent 100% of the time and there's no hiccups, because that's not real estate. As far as cash flow, I would typically like to see at minimum in our market, right now, and I know this is tight, so don't beat me up about it too bad, but I'd like to see a minimum of $500 net cash flow per property. That is significantly down from what I would have anticipated over the last couple of years. But what my belief is that rates will not be 7% 2 years from now. And so my mental strategy is I still want to be accumulating property. So hopefully, if you've been burning properties and adding to your portfolio over the past, 3, 4, 5 years, is that the cash flow you're receiving for some that you already have done will make up for the lower cash flow, the ones you're accumulating now. But the sum of all of those over time will be your net worth. As we move forward, even if they're not cash flowing that much, if rates go back down to even 6.5%, we might have a pickup there on some additional cash flow. Or maybe you've taken the excess cash flow from your properties that are on a 3.5% rate, and you're using that cash flow to pay down the mortgage at the 7%. So all of a sudden, we're also getting some amortization savings. So it's on the surface, if you're looking at one specific property, they are going to be looking tough for BRRRR unless you're getting a significantly discounted property.
Don't you think part of the risk on the BRRRR right now is we don't have any stability or predictability of, you can't control what sells around your property?
Yes.
like some agents are talking their seller, they'll talking the sellers. Agents still have influence, right? And they can talk them into taking the lower price or not. You don't know. You could have, 2 or 3 properties around you sell for less, and that affects your appraised value, when you go to do your refinance and you need to build that cushion in, thinking the end of the deal. You got to start with the end in mind, right? You got to start with your refinance in mind, both on rate and on the appraised value, because rate's one thing, but if properties in that neighborhood sell for undervalue, or how many properties do you need to create a story? One doesn't tell a story. Is it 2? Right. Is it 3? What do you think, Augie? How many properties tell a story on comps?
Yeah, so the current direction is lower because, quite frankly, one of the things that people expected is that when rates went up and home prices became decreasing, that inventory would flood the market. We haven't really seen it. There's still really low inventory. And so I think what we're seeing is that a lot of the homes people either have a lot of equity in or very low payments. And so they're saying, I'll just wait to sell, or I will convert it to a rental. But what that does mean is that the homes that do hit the market are likely in a situation where they have to sell. And when people have to sell, that's when deals are cut. That's when people get, 20% off price or whatever it might be, whatever the crazy story is. And so you do have to be very careful right now. And I think how you protect yourself is a lot over the last 3 years. I saw a lot of investors buying stuff that was very skinny on margin, stuff as low as 5 and 10%. And they were kind of banking on appreciation or, low rates in order to make it work. And part of the reason why rules are a rule, like the 70% rule, which is all over the internet, typically 70% rule doesn't really work too well in Washington. There's obviously some great investors making it happen. If you're sourcing the deal yourself off market, that's probably more likely. But even using a 75% rule, people were getting away from that and saying, you know what, there's enough room here to flip it. In worst case, I'll refinance it in a 3% rate as a BRRRR. Well, that exit strategy only works, of course, if you have the equity. So we have seen a lot of flippers recently get their product to the market. It did not sell. They're now 90 days in, and they're debating either taking a slightly lower offer price and losing maybe 10, 20 grand on the project as a learning lesson, or whether they're going to refinance it and leave all their capital in that project. Depending on the particular investor and what their cash position is, whether or not to take that loss and get your capital back, or whether to hold that as a rental, is going to be each person's individual decision.
Absolutely. Yeah. I mean, there's almost a little tell-all, I think, on you can kind of, like you said about studying the market, sellers who are willing to drop their prices are probably the ones that are wanting to sell. If you see something on the market for 45 days, or something with no price drop, those are people that probably don't need to sell, but that's also an indication of somebody you might be able to pick up a lease option on, or some seller financing on, because they're holding the line and they want to get a specific price. And in order, you can talk to them about, in order to get that specific price, we just need to trade some terms.
And a lot of that is exactly what you're looking for, Julie. So, every single seller, this is what's so funny that I don't think enough people realize, people list their house for one reason. They want to sell the house. People don't just willy-nilly get up and say, you know what I'm going to do? I'm going to throw my house on the MLS today, right? And so if it is listed, that person wants to sell. And if it hasn't sold, they're going to be in a situation where they're going to be more willing to pursue some additional options. Now, to kind of talk a little bit about how some of that works, most people who own a home do have some sort of mortgage, particularly in our market, because the home values are higher. However, a lot of those people may have owned their home for a number of years. So an example would be maybe they're in Phoenix Ridge, and maybe 10 years ago they bought that home for $1 million. Now they're trying to sell for $2 million. When they bought for $1 million, maybe they had a 20% down, so they only had an $800,000 loan. So they might need to be able to cover whatever the balance of their loan is left, $800,000, let's say. Well, perhaps we could take out that $800,000 with a traditional mortgage, and the seller could agree to have some sort of seller carried second mortgage, and the blended rate on the two could be lower. An example of that would be if we had a 500 grand mortgage traditionally with a 8% to make the math easy, and we had a 500 grand seller carried second at 4%, then that would blend into a 6% on average. So there's ways to make housing more affordable, and it's having that conversation with that seller about what they need. If they need price and they need X amount of dollars, can we get creative on how we think about that to meet both of those goals and still make it work for us?
Augie, will a conventional lender, like you said, take out the first loan at 800 or 500 or 800, let's just say, with a conventional loan, and let the seller finance the second position? Are the lenders allowing the second position, or how does that work? That's always, I think, the big question.
Yeah. So basically, there's a couple different ways that we've done it. We've done some bridge financing products, with a refinancing afterwards. We've done some hard money products. It's really just dependent on the person's what they have for down payment. So all conventional loans will require some portion of down payment. You'll have to at least put your minimum. So even if there's a bridge product, second mortgage, you will have to, there's no zero down financing on conventional loans.
But they allow a second position.
Correct. They will allow a second position.
So is that, what about a wrap versus that setup that you just mentioned?
Yeah, so a wrap, in case people aren't familiar with what a wrap is someone has their mortgage on their property. And, so I have a 3% $1 million loan, and I decide to sell to Julie. Julie buys my property. And so what she's going to do is I will actually keep my mortgage, and then Julie will make payments to usually a third party, like an escrow company or something like that.
For Evergreen.
Or some servicing company. And then that company will actually pay the mortgage payments to ensure the mortgage payments being paid. So in essence, I become Julie's lender through my own loan. That is an option that we saw a lot. And what's interesting is these are things that we saw a lot in 2005 to 2011 territory.
But that means the seller doesn't need their credit to go move on with their life.
Yeah. So
because their loan is going to, they're wrapping a loan to you around their existing loan.
So exactly. So you're going to have to really figure out what a seller needs. So conventional financing and jumbo financing has carve outs for how to deal with debt that's still in a buyer's name that is being paid by another party. Usually those are around 12 months of payment history, proving that you have not made that payment, and then understanding the agreement associated with that and documentation. So if that seller, as an example, how I might approach a seller is, okay, so assuming that you are able to sell your home, or first, what's the reason for you to sell? Are you relocating? That's probably the biggest issue for someone selling right now, is they're relocating. So they have to sell because they cannot move without doing so. So are you relocating? If you relocate, you're probably not going to know that area as well as someone who already lives there. So it might make sense for you to rent for 12 months and figure out exactly where you want to live. And so this structure might work for you because I will make your payment for 12 months, at which point you can then document to your lender that you're no longer making that payment and therefore qualify for that loan. Also, over that 12-month period, who knows what the market might be? I might be in a position to refinance you or whatnot. So terms are very important because humans have needs and they are more flexible than banks, right? So if I'm moving and relocating, possibly I'm not even planning on buying for 2 or 3 years. So maybe I'm willing to give you a mortgage wrap loan for 2 or 3 years. And then if you do not pay it off in 3 years, I'll take the home back.
I think a key there, the very key thing that I think is the gold on that particular subject matter, is letting the seller know that if somebody else makes the payment on time consecutively for 12 months, right? What was that recap? That's the gold to get somebody, because that's going to be their hang up, cover that one more
so
time.
Typically what happens is, if you have a mortgage on a property or any debt, car loan that you've co-signed for, maybe you co-signed for a friend's house, which is the craziest thing I've ever seen, but people do it. if you can prove that another individual has paid that payment for 12 months, and again, whether you're jumbo or conventional, this will change, or FHA, but if you can prove via documentation that that has been paid by another party, you can typically exclude it in most cases. And what that means for documentation is 12 months canceled checks, or if someone is paying via ACH through their bank. Typically, we're requesting 12 months transaction history from their bank account, or in the most extreme cases, 12 months bank statements if that person's unable to provide something that proves it. Where people get caught up is they get caught up when, again, the thing that would be tough is if that buyer buys that property and then does not make that mortgage payment, that's still on your record. So if you go late on that mortgage payment, it's still your obligation under the terms of your loan to make sure that payment's made on time. So the seller who's agreeing to this is going to have that concern. So they're probably going to want to know about your financials, just like a regular banker would, to make sure that they're going to feel comfortable with that. So if you're presenting an option like a wrap policy or something like that, you're going to want to make sure you get all your information documented same way you would for a bank. Like, here's my W-2s, here's my credit report, here's my pay stubs. You can tell I would be qualified to make this payment. That's going to help put them at ease and be more comfortable to maybe give you some sort of unique relationship.
Are you aware of any services, like what are we calling them, an RMLO, or would somebody with a lender like yourself be willing to look at that documentation to give confidence to that seller for that buyer? Or is that a waste of your time? Or is that considered pipeline business for guys like you?
Yeah, I mean, that could be pipeline business. So basically what we do is like, just like a pre-approval. So a lot of times when I try to approach sellers is it's like, hey, look, I'm qualified. Here's my pre-approval. I could buy $2 million. And I've even done it for cash buyers, right? Like, here's a cash buyer. I've verified his bank accounts, because it's relationship based. And that could be a way to get that taken care of. We've also done that for situations where it was a seller carried transaction or a longer closing, where we've been able to say, hey, we've documented the exact issue that is holding us up from conventional financing or FHA financing. And we know definitively, short of that borrower losing their job, that they will be able to execute on such and such date. Having that information, go ahead and do the transaction, and then we'll be there to do the takeout financing.
That's what I do if I broker or do a lease option. That's exactly what I do. I just, you can plan everything in advance. It can be extremely smooth.
And that's really important too, because, what I found, a lot of people call me up, regular investors, and they'll be in a hard money loan or some sort of investment. And they're calling me at the end because they didn't work out how they're thinking. And they're like, how do I get out of this transaction? If they would have done that up front, they would have found out that there was no backup transaction for them other than hard money or foreclosure. And so I really want to make people aware who listen to your program, newer investors in particular, is if you are going into an investment, you absolutely want to talk with a lender, specifically not your friend who's a lender or not Bank of America, but someone who does investing specifically. That person's going to be able to completely review your scenario and give you some level of confidence that you'll actually be able to do takeout financing.
Not only that, you guys, if you're active investors and you're not just a one-off deal, you need to check in with we'll call it your property doctor. Okay. Like Augie here, probably every 6 months, because as you're buying more properties, your financial picture is changing. And so what might've worked 6 months ago for your takeout financing or your runway to exit a deal, every time you actually purchase a new property and you take on hard money or whatever else, you've now changed your situation. And so you need to be checking in with your coach, your lending coach, your exit strategy, your runway coach, whatever you want to call it. Every time you're going to do a transaction, you say, I'm going to do this transaction. How is this going to affect me moving forward? Because I need to still refinance that one over there. Right, Augie?
Oh, absolutely. And far too many people, this is the reality is we'll get new investors who are like, hey, I would love to have a conversation with you. And I'm like, fantastic. Let's fill out an application and actually see what we can play with. And then we can know exactly how to have that conversation. And it's almost as if new investors are more scared to have their credit pulled than to invest $100,000 on a property with a hard money loan that could foreclose on them in 6 months and then just figure it out later. And I'm like, what's funny is I'm an investor. I have my credit pulled probably 22 times a year. I don't care. I'm a 780 FICO score and it doesn't matter. Even Jeff Bezos has his credit score pulled, right? But it's almost like that singular thing. They read one thing on the internet about how don't have your credit pulled too much time.
Yeah.
It's more frightening to get the actual information they need than to actually just jump full forced into an investment. It's
yeah,
bizarre.
I always said, I used to talk about this with Albert all the time. I feel that the entire real estate investing, whoever's out there coaching all this stuff, they're teaching it backwards. They're teaching it backwards. Everybody needs to become a debt expert, understand how debt and financing works. It opens up your opportunity to buy deals. You see things differently because you know what your exits and your runways are. You must know what your exits and the runways are. And I'll just say it one more time, you guys. You buy a property. You did the right thing. You figured out what your runway and your exits are. Augie told you you're good to go. So you move on with that project. And you're like, this is awesome. I've learned how to find deals. You go find another deal. You forget that you still have to refinance the first one. And now you've clouded up your borrowing ability because your other deal or two is out there, and you take on the third. And however you finance the third messes up your ability to exit and finance the other one or two. It's a global picture. Every time you buy a deal, you need to check in with Augie, and you need to check your runway of being able to add on another deal if you still have properties that aren't put to bed on their stabilized loans, or what your exits or whatever are still going to get affected by the new deal.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show.
Correct.
And remember, taking on partners is also risky. Give them a little to do on that one, brother.
Yeah. So, I mean, the other thing that people do a lot is they'll say, well, I bought a partner. So Joe and Julie bought a property together and the mortgage is just on Joe's. So I don't need to count it into my financing. Well, you still own part of that property. You probably still signed on the deed of trust. You probably maybe even were required to sign on the note. If you didn't sign on the note and we can show that Joe has paid it for 12 months, we can exclude it. But if you just did this yesterday, no, we have to count that against you. And even if we don't have to count it against you, we're still going to have to count the taxes and insurance against you. So like you said.
And when you go to take your BRRRR out and qualify for your stabilized loan, is it possible that your partner that you didn't know that well, that just happened to have some cash,
right,
doesn't have a great credit score or something's up, and the combined nature of the two of you, one being a rock star, one not, but had the cash for whatever reason, takes you down? And you, right? Explain that one.
It all plays back to everybody will talk a big game, and I can make assumptions. Like I can assume that if I partner with Julie, that she has an income and assets that would help me do a project. But what if Julie really didn't? What if I only did one deal with her, and that happened to be the only deal that year. And I made all my assumptions that she had one every month, and I was just only one of those months. So when we make assumptions, that's when we get in a tough space. So people see.
Or what if I'm out doing a bunch of other deals, not with you, and now
Right.
I've clouded my own ability on something or had a bad deal somewhere go
Exactly.
wrong, and I had to take a hit, and you're still my partner on our deal, and we're gonna need to go refinance together. You need to be very careful.
The key to all investing, whether with a partner or by yourself, is making sure that takeout financing is taken care of, even if the exit strategy is sell. Because if you can't sell, your option is going to be to lose or potentially refinance. So you want to know, even if the option is sell, what your takeout finance would be. So at least you have an alternative option to loss. And what that is it's a very simple pre-approval. It's the same form for every single bank. It's Fannie Mae, Freddie Mac standard uniform residential mortgage application. And it takes all of 15 minutes to fill out, maybe another 30 minutes to gather your documentation and make sure it's accurate, and then properly planning how to execute. And before I take on any transaction, I'm making sure that my financing is in place. I'm making sure what my exit strategy, worst case scenario is going to be. And I'm making sure that I'm having everything run to make sure it's good to go. You just
but specifically on a BRRRR, you need to be thinking forward, guys, of what's going on in your life, because this is a loan you're getting 6 months down the road. So if you have things coming up in your life or whatever that might be, don't go buy a car. Don't do shit like that, because just because the snapshot of the day you decided to analyze this deal, you were qualified to do the takeout, life goes forward.
That's a very good point. So, the thing about investing in real estate is it's one of the only opportunities that we have to really leverage our investment. So I can take control of $900,000 of assets for roughly $35,000 down payment or something like that. So the thing is that it's highly leveraged. And so it's based on the success of that debt. Now, leverage being debt. So if I'm not able to get that debt, well, I had $35,000 to get into the situation. I don't have $865,000 to get out of it. So if I go buy another home because I'm so excited, if I buy a car like Julie mentioned, that could throw off my debt to income ratio to the point I do not qualify. And what we do see with investors in general, and I don't know if you see this, but they tend to dive all in. So they say, I'm an investor.
Thinks global. They think
my
one
job,
at a
buy
time.
3 properties, buy a car. I want the whole life right away. When really, I tell everybody, there's nothing sexy in becoming a multimillionaire. It's ugly houses, long hours, and crappy jobs, right? Now, what happens if you do enough of those over time, you will get there 100% of the time. But if you just go out trying to be the top and trying to do the best and trying to do the maximum, that's where people lose everything as well. And we all have a choice, and this is the choice that we all have. We can have discomfort today for comfort in the future, or we can have comfort today for discomfort in the future. What I mean by that is if we make tough choices today to not spend our money and to invest it properly and do it step by step correctly, that might not be as comfortable. I might take less vacations. I might have a lower quality house than I want my friends to see. I might have to, drive an old Hyundai instead of a Tesla, right? But if we make those choices today, I'm going to have more money and more success in the future. So while all my friends are freaking out about where their retirement's coming from, I'm going to be in Maui, right? And I'm going to be having great fun. I'm going to be drinking pina coladas, where they're going to have all that fun today because they're going to spend all that money. They're going to buy all those cars, living paycheck to paycheck, get to the future. And they're going to be like, holy crap, I have to keep working until I'm 80. And the reality is nothing gets easier.
I got a good analogy for you. Yeah. So when I was in high school, I worked at Safeway. Yeah. I was the bagger in Safeway. I was killing it, buying my mountain bikes, Joe, and everything as a bagger in high school. So good. I was good with the people. They're like, Julie, we want you to run the deli. We want you to go to Safeway University. Well, I was making more money than all my friends starting young, having this great job with the union at Safeway. And if you think I think about it, I think what you just said reminded me of that. Like I could have made so much more money in the short term of the time that my friends went to college, and I'm making my 20 something dollars an hour at Safeway, living the good life, supposedly, while they're all, going to college and doing what they're supposed to do. And then the moment that they graduate and get their jobs, they're making $150,000 more than I'll ever be able to make. And because I thought it was so cool to have the money now instead of later. And that's what real estate investors do, right?
Oh, 100%.
They want it now. And the real winners are the ones that go slow.
Correct. And to touch base on one of the things you started the podcast with was, once you have a family, once you have kids, everything will get tougher. So, and it will continue to get tougher because there will never be, everyone can just look at their own life. Life does not get easier. It only gets more complicated, more full of things. And the only way it gets uncomplicated is if we take the steps as soon as possible to get ourselves into a better position. Absolutely. So with 2 kids now and maybe a third in the next 12, 24 months, I no longer am going to have the ability to do all the things that I did when I was 26 through now. But if I hadn't done those, I would still be saying, okay, well, what sacrifices do I need to give up today to still make sure that maybe when I'm 60 or 70, I'm still taken care of? And it might be very uncomfortable to have to move to a new location or relocate your family every couple of years. But that discomfort for the 3, 4, 5-year period you do that to accumulate just 4 homes or even just 3 homes could be the difference in you retiring or not.
It's an interesting thing. It'd be cool if we made Augie, put our heads together with some of our smart friends, almost like a investor's life checklist. These are kind of the options that you have. You can either go down this path where you're willing to move and get yourself mentally prepared for you and your family and make sure you have a spouse that agrees to do that with you and has the same vision, because the whole spouse thing can throw things off. Or you're going to have to maybe, if you want to stay more stable and you don't want to move to take advantage of the house hack stuff or whatever, then your path looks more like this. These are, as you're getting started, understand these are the choices in front of you to pursue the path as an investor, right? One might be shorter than the other. It'd be a really cool.
You could kind of have a map like single and below 30,
totally
to married to married with kids. And
it's true.
All the different stages. And, it is different for everybody.
Flow chart of your options on how to move your life forward. What are it's legit because while there is unlimited options, there's sort of not unlimited options as well.
Correct.
Right? I want to jump on something for a second though. I want to go back to this creative ability and this runway issue. What do you think? I did one of these deals specifically in 2018 when I did a lease option where the seller wanted to remodel this awesome, or the buyer, the tenant buyer wanted to remodel this awesome mid-century home. I just actually sold it for them. I just listed it, in the last month and we crushed it together. That was a whole lease option deal that I had put together in 2018 for a regular old buyer. But what do you think about grabbing properties on lease option that your intention is to BRRRR and the seller gives you the right to make improvements to the house with their approval during your lease period? Now there's some risk because you're putting money into a house that you don't own, but yet you are 100% in control of purchasing the house because you have an option to buy it. So it's really not as risky as it sounds, as long as you have the right amount of time on the runway to exercise your option, and you can get financing, or you have some terms in there that will cover what happens if it doesn't appraise, or which it will because you would have improved it by then.
Right.
Or if you need an extension for rates, you could really build something rad around that. What do you think? Risk, no risk?
I think it's actually great from the standpoint of you're actually mitigating risk. I think that this recent 12-month period is really putting things into perspective. We've had an easy market where it goes up 10% every year, right? Now we're having a hard time. So realistically, if you can get that, what I think is important is just making sure that you have lots of backup. Kind of like when you jump out of an airplane, you have a parachute, you want to have a redundant one as well. So if the first one breaks, you can cut your ties and try the second one.
Let me tell you the risk. You need to make sure that underlying seller, right, pays the mortgage during your term on your lease, because that could screw things up if they get foreclosed upon or maybe you could write into the lease option that you have you can put a lien on the property or something like that for your improvements that you've made. So you're protected and you've clouded that title. That's what I would recommend. Cause you gotta, we always worried about investors being bad actors. You have to worry about sellers being bad actors,
especially like, for people out there who are pursuing unique creative structuring. Understand you don't want to get into a unique creative structure with somebody who's in a bad position themselves. Okay. So what I mean by that is like things happen to all of us, no matter how successful we are, how much money we have. Like maybe you lose a job, maybe you get an illness, maybe you have a death in the family, something, correct? But if you're going out there trying to do a lease option with somebody who's like in foreclosure,
right.
Likelihood is that it might not go to plan how you do it. So with a lease option, you would definitely want to have some sort of protocol, especially if there's like a lot of lease options have some sort of lump sum down payment component.
Yes.
That is secured against the property, that there are terms outlining how that mortgage is paid. Like I would definitely recommend having a servicer
Totally.
the actual payment and then cut. Usually what you're doing is you're paying a little bit over what their mortgage payment is. So having that excess be paid to the seller through the third party versus just giving the third party money. You all have to realize is that, where I might do 200 transactions a year, most people are only even real investors might only be doing like 4 or 5 transactions a year. And then regular consumers are maybe doing one every decade. So you're structuring a very complex thing with an individual, and that individual might have zero knowledge about anything and might be in a bad financial position or health position that impacts you. So do make sure that when you're structuring with the seller, you don't only find out what their needs and wants are, but you find out more about their financial position as well, and whether or not they're the type of person who is going to work with you and give you the safety protocols in your contract to make sure that you're setting it up correct.
If you guys want to go through one of these, you call myself or Augie. It's really not that much rocket science once you take a real life example and you have, we're talking about a lot of stuff here. It's not that complicated. There's like a checklist, literally a checklist that you can go through. Every transaction on a lease option is going to be unique though. Right. Yeah. So you can, I even build them in with waterfalls of if it doesn't appraise. So then when you get to the option, when you're exercising, if it doesn't appraise, especially in a market like this, that it's already pre-negotiated, because you can't have a deal fall apart with an appraisal that's coming in with in the event of a low appraisal and that screw up. And now the buyer and seller can't agree. And that, now the seller's already spent the option money and they can't give it back. It's you just need to know the parts, and it's honestly not that complicated.
Yeah. And, it's just like with commercial financing, like not many of you probably see commercial contracts, but commercial financing addendums actually include not only ability to get financing, but ability to get financing at a set rate. And that's because if the rate spread versus the cap rate spread is not there, it's no longer a deal.
Right.
And certainly we've seen that executed over the past 6 months, almost on everything as mortgage rates have increased so much. So
you say that in your commercial deals, you're writing in on your financing contingency that you have to be able to achieve a certain rate.
Correct.
Because that's how you're dictating your cash flow. Right.
Correct.
Right.
So yeah, because when you're buying multifamily or income producing property, you're buying it to generate income. And the income that you generate is a function of your rate. And so what we're seeing is with mortgage rates on commercial debt increase is that we are seeing better cap rate multifamily come to market, which is a great thing for cash buyers. But basically, you need to make sure that you're cash flowing. So I've written into most of my contracts, I had a mobile home park under contract, and I had written in that I needed to obtain financing no more than 5%. This was back when that would be considered higher than market. So I am taking some risk that it could go up, but they ended up going up higher, and especially for this particular Class C mobile home park, where it would no longer make sense to buy because I would not make cash flow. So you do have to build in things that protect you on a lease option for the financing. So
totally. Everything is about financing. Everything is about financing. The rest comes second.
And I don't think people realize how much lenders do. Like they're just like, oh, that lender, he's just charging me this rate and this cost or whatever. And it's like, you do realize that we actually go through every single one of your bank statements, analyze every deposit that's over X amount, depending on your program. We go through your tax returns with a fine-tooth comb and actually see whether your business is liquid or illiquid. We go through, your entire financial history with your employment, verify stability of that income. We probably know more about your financial situation after we've gone through your pre-approval process than you do. It's right. And it's just discounted. It's like, look, you might pay a financial advisor 1% on all your assets to tell you to buy a mutual fund when a pre-approval is free.
Yes, so. You guys, now is the time for creative real estate. Is the sellers before were not wanting to listen because they could throw their home on the market, get 10 offers, and that's all they could hear. They just thought, I'm going to get multiple offers. It's going to blow up the price. They would not even consider. Obviously lots of people were getting seller finance deals done, but let's just say the gates are open if you know how to converse as a modern real estate professional, whether you're an investor or a broker, right? And so with a lease option, that can be a short term. The seller can get paid out and all their proceeds paid off. That could be a 3 month, 6 month, 8 month, 9 month, 1 year, 2 years, 18 months, could be anything, right? But with seller financing, when they're going to actually seller finance the property, a lease option is a creative form of seller financing, but they, you tell me if I'm wrong, with seller financing doesn't, unless you're using maybe some sort of contract for deed, the seller, due to Dodd-Frank, must offer a 5-year loan term. Is that accurate?
I would have to look into that. I have not looked into that.
I believe, for anybody, call me up and correct me or comment down below, unless you're using some sort of contract for deed where the deed stays in the name of the seller until some sort of trigger point happens, okay, that might be different. But my understanding is with the Dodd-Frank rules, and we should circle up on this afterwards, Augie, and be sure about it, that a seller who's offering seller financing must offer no less than a 5-year term. So the difference on whether sellers want to accept seller financing or a lease option is with seller financing, traditional straight up, not contract for deed, they have to be willing to carry that for 5 years. Okay, they can get refinanced off before then, sure, but they have to offer it to you for 5 years. So you have the option to do it for 5 years. That's why I like lease option. That's the conversation. Do you need your money now? No. Are you flexible on it? Do you need it in a year, 2 years? What's the situation of when you need the money? Well, I don't really need it. Well, seller financing is great. Well, I need to have it because I'm getting married in a year. That's one of the situations I have. I'd like to get the money because I need it in a year. Well, then the only way to get it to in a year is maybe more through the lease option. The other thing about the difference between lease options and seller financing is with seller financing, the buyer doesn't perform, they have to foreclose. Some of the older folks they feel I'm too old to go through this foreclosure stuff. No problem. Here's your other option. It's called a lease option. We're going to separate the lease from an option to buy, from a purchase and sale agreement. They all get signed at the same time. But if that buyer fails, not only do you get to keep their non-refundable option fee, which I always try to get it to be 30, 40,000 or more because of how there needs to be some things paid out of that. But now if that tenant buyer doesn't pay on time or whatever, that you can just evict them. That's the difference. You can just evict them. You don't have to foreclose. Lease option, you can get your money paid off in 6, 9 months, 12 months, whatever your lease term is or option term is. Seller financing, I believe, that seller has to offer 5 years. And that's an easy draw the line conversation on, you take them down a straight line of their options, guys. This is what my whole life is about, my VIP education community. And this is my modern real estate boot camp. This is what we talk about. The gold is in the middle conversations, cash offer, listing. The gold is in the middle, conversing to convert in the middle. Doesn't matter, you're wholesaler, investor, burr, flip, whatever, broker. You can do all these things. You just have to know they exist. It's not that complicated. You just have to almost just have a checklist of how to run through the deal, right? Augie and I can teach you that. Jan, everybody out there that talks this, I call it modern real estate. Learn to speak modern real estate right now, because right now it can be deployed. 3 years ago, nobody wants to listen except for if you're super skilled and you find that needle in the haystack seller. Right now, all sellers, I'm telling you, are willing to listen. All of them, because they don't have any other choices. And you're going to be the one that can have that conversation with them. Okay. I'm telling you, it is the best time possible right now to just boom your portfolio up, boom your brokerage business up, right? You don't have to know how to do all these things. You just have to know who knows how to do these things and put them on your hybrid team. Okay. That's my entire business model, working with wholesalers and investors that spend all this money on marketing. And when they can't execute on what they're marketing for, they call me as their concierge partner. I can get the deal done or help them get it done, pay them their referral fee or however that needs to work out. Same with Augie. You need to have your team to execute, and you have only maybe 12 to 24 months to blow this up right now. Everything we just taught you, if you can just get a runway of 12 to 24 months with a lease option or a seller finance deal or wrap, whatever creative terms, you only might need 24 months. That's such an achievable runway. I like the word runway. I'm going to get you and Tarl and everybody's wearing those shirts, grind, whatever. Mine's going to say, what's your runway? Something about runway. That's my buzzword. So yeah, lease option to a BRRRR, right?
There you go.
There you go.
Mitigate
What else?
the risk. Well, other than that, just, know what your strategy is. The market has shifted. I think it's important for everybody to reanalyze what they're doing and making sure that the path that they're doing is going to be the best. Anybody who's under contract on something that might be a little bit of a suspect flip or low margin or have some risk, really consider whether it's worth pursuing, even if you have hard earnest money, if it's only 5, 10K. Well, is it still worth it versus finding another opportunity?
Do you think the hard money lenders that are out on these BRRRR deals want to actually foreclose, or is it possible to do some loan modifications with them?
I don't think that they want to foreclose because that's not the business model. The vast majority of hard money lenders, their goal is to earn interest off of their loan. Also earn points off of the lending, the origination of those loans. Now, obviously, if you can't pay, they do want to have that money back. But I would say that the vast majority that I have seen will do some sort of extension or workaround, et cetera. You may need to put more cash in a deal if the valuations have changed, and again, at the end of the day, if you do not pay, they will foreclose because they are in that business. But I don't think that's their intention. Right. And part of that's really to re-say, like we've said this whole podcast, figure out everything up front to make sure you have options. If your only option is sell, make sure you have more margin than you need.
What's your quick last question advice? Then we went really long here because Augie's worth it, guys, and you know it. For the multifamily investors who are buying the value add deals on the bridge loans, what that means is that you're buying a property and you can borrow a good chunk of your renovation proceeds up front when you purchase the property based on the exit, stabilized value of the property, right? And those people are you get caught in your bridge loan right now, and you didn't leave enough cushion for your refinance stabilized loan. What's your advice to people pursuing? Because people should be pursuing those multifamily deals right now, and they're going to want those bridge loans still. What's the word on that?
One is start looking into financing early. Most of the well-priced lenders out there for the multifamily stuff are taking 90, 120 days to even do a deal. And we're still securing decent pricing, meaning from 4.7 to 5.5% on stabilized assets, even if it's like a rougher area or tertiary market.
On commercial size loans.
On commercial, correct. So this is like your, let's say 10 to 50 unit apartment building or something like that. So the one thing that you're going to want to do is you're going to want to negotiate the longest interest only term you have. Also, we're looking to, changed over from building spec homes to building out our multifamily portfolio because where spec homes are slower and considered to deteriorate over the next 12 months, rental properties have increased. And I do believe that with the cost of housing, rental market will still continue to increase. So we've switched to that market, but the commercial lenders are scared to death about what rates will be. So they're not even offering fixed rate terms on construction to permanent financing. They're doing almost float. So what we're negotiating is the period for which we have to float that rate for the fixed. One of my great partners here locally offered 24 to 30 months of construction term, interest only. That would give me 24 to 30 months from the date we close to figure out what's happened to mortgage rates at that time. The reason why that's important is I don't want to get stuck with that fixed rate if rates are at 7% and then have a non-cash flowing asset I have to foreclose on or give back to the bank or whatever, where I can continue to rock that interest only payment during the construction period as long as I can, let rates have a time to readjust and come to a normal market, and then lock in that fixed rate. And it still might be higher than I anticipated, but it's not going to be forcing me to take it if it's a bad rate at that time.
The other thing that apartment investors should do is they should be having a forecasting model with their renovation. So you take your, projected budget for your renovation, your lease up and your renovation plan, and every month you're going to plug in what your actual numbers are behind that, and then it reforecasts forward. And this is where where your trigger point of your refinance is in the future. And that allows you to track your progress in your forecasting, that you're able to see, am I going to make it or not? By the time you're going to know this a year ahead of time, am I going to make it or not based on my actual to budget forecasting model on my renovation of my apartment building? And I might need to pull the plug on renovating all those units. Where can I get to where I know I can refinance out? I might not be able to pull as much cash out as I wanted, and I might have to do this in 2 phases. But you're going to start with your construction renovation budget. Every month you plug in the actual numbers and you reforecast out for that next 12 to 18 or 24 months. It works. I call it my Bible. It is amazing. It steers the ships and it helps you make your decisions way in advance, because you don't know how much you're going to have to give in concessions or how much vacancy you're going to have or whatever's going to happen that's going to impact your road to your stabilized refinance period. And so the forecasting, plug in the actuals, reforecast out your budget, is an amazing tool. That's not complicated. It's just an Excel spreadsheet, man.
And for investors, this is not for the newer people, obviously, because we're talking about commercial, but for investors, I just think that right now, if you're not out there who's someone who can raise a ton of capital like some people do, and you're just using your own funds or maybe you and your buddies, just understand that right now, the most important thing you can do is, like what Julie said, stay up to date month to month. So you can change on a dime if that direction is to liquidate, if that direction is to refinance, not as much cash out, and also get as liquid as possible. This is not the time to put all the money on the line. You're going to want to remain liquid, not only to make sure you get through that project, but if the rates change so significantly, you have to bring additional cash in to meet debt to service coverage ratios. You're going to need to have that capital to do so to get that permanent financing. Best case scenario, everything gets better, great, you made more money, and then you can take that cash to buy a discounted property. Worst case scenario, you have to use it to make that investment work out.
All doable. Such an opportunistic time right now. If you have all the tools that you need and all the teammates on your hybrid team, I'll be your teammate. Augie, you'll be a teammate.
I'll be a teammate.
We've been here for a long time trying to help you guys out with all this great free information. So don't be afraid to move forward. Just go get yourself an opportunity and then call your hybrid team to help you get through it, right? Now's not a time to be scared. Now's the time to be damn excited, because the sellers are open to listening because they have no other options right now.
Absolutely.
Word. Well, awesome stuff. My favorite phrase of today, guys, that Augie said, and he probably doesn't remember that he said, is, but my question to all of you is, what is your alternative option to loss? That phrase is cool. What is your alternative option to loss? That's what we're talking about. Get your runway, reverse engineer into your deals with the end in mind. That could be a 2-step process. And listen to this podcast about 5 more times and you'll get the flow of what we're talking about here. My big takeaway here as a reminder is that for sellers who they're going to stay engaged either through a lease option or through seller financing, that if their payment is made from a buyer making that to like Evergreen Loan Servicing or whatever for the 12 months of documented payments, right? There's a potential there that debt can come off their record for qualifying for the future. How would that ever be solid though? You would never really know whether it's achievable or not until it happens.
Hey, look, how Fannie Mae guidelines work is, I don't know if anything is solid, but that's the black and white guideline, right?
Right. But it's a runway.
Yes.
You can offer the seller. Sometimes they just want to know that there is something that can happen. I'm cool with it. I'd prefer it this way. And you say, well, one of the options that might be a possible potential, is in addition to that, on the lease options, buyers might say, yeah, I'm willing to pay that rent, but I want $500 of that rent to go towards my down payment when I exercise the option. And you say, sure, I'll give that to you if you pay on time or no. And that's a term that can be negotiated. And it just interlinks with what we said about giving the seller confidence that maybe 12 months of payments on time. If you're writing that into the lease option deal, that could be your MO. That could be an incentive. Go ahead and make your rent a little bit higher so you can offer seller a credit back towards the down payment. And that's actually a backdoor way of incentivizing that buyer to pay on time, which might get you off the hook supporting this loan 12 months down the road. It's a yin and yang, an incentive-based structure, if you guys are following what I'm saying, right, Augie? You get what I'm saying?
Oh, absolutely. I mean, everything you can do. And if you're unable to execute, then that seller is going to get all that extra money. So it's a win-win.
Yes. That means they don't have to credit that towards your down payment. Towards paying down the house on the purchase price is what I mean. So
exactly. It could be a windfall for them if you mess up. So,
all right. Well, Joe wants to get back out on those mountains, guys. Right, Joe? Time to let Joe back on the bike. That's
Heck yeah.
Sure. Heck yeah. Awesome. Well, thank you guys for sticking with us today. This was a long one because Augie's always full of the great information. I know myself and Augie and all the rest of our investing community are always here for you. Seek out the classes. There are some great opportunities for you guys to learn from local investors that are doing this rather than out-of-state gurus. We got you covered, right? If you're a broker and you want to get into my boot camp on this, how to learn how to speak modern real estate, just hit me up. You can DM me, you can text me, you can find me wherever you find me. And I'll be happy to talk to you more about that. Build your hybrid team for the next 12 to 24 months where you're going to actually go out and crush it. You don't need to know everything. You just need to know the people that can help you get these things done. You just need to have conversations. All right, guys. Joe, where can everybody find Augie? How about if people want to reach you, though? Where can they reach you?
Absolutely. They can go to edmundslending.com or type my name into Google. You'll find lots of pages with all my contact information. My cell phone is what's listed online. So we will be able to get in contact. Facebook, Instagram, if you follow Seattle Luxury Homes or things like that to look at our inspiration or projects, feel free to reach out and IM, DM, text, whatever's convenient.
That's right. So Augie is your property doctor that anytime you do a transaction, you need to check in and make sure that your temperature is still looking good for your next deal. He's also a buyer for your deals. Okay. How awesome is that? That's easy, speed dial, check the box 2 times. So thank you guys. Joe, where can everybody find the details of today's podcast?
Yeah, you can get to all the show notes from today's podcast at seattleinvestorsclub.com/169. That's seattleinvestorsclub.com/169.
Awesome. And don't forget to give us a like or ring the bell or whatever. How do you say it, Joe? So we can get
Smash the like button.
Smash it. All right. Bam. Thank you, everybody. And we'll catch you next time. Thanks, Augie.
Bye, guys. Have a fun weekend.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.